This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
New milestone. The Dow closes above 16,000 for the first time ever. And some are saying the great rotation out of bonds and into stocks is here, finally.
Underwater insurance. A large number of homeowners still owe more on their loans than their homes are worth. But now there's a new type of insurance designed to protect consumers against negative equity.
Plugging leaks. Every day in Baltimore, 3 water mains break on average. Tonight, in our series Mission Critical, Fixing America's Cities, we examine the budget-busting cost of repairing our municipal infrastructure. All that and more tonight on Nightly Business Report for Thursday, November 21st.
Good evening, everyone. The Dow closed above 16,000 for the first time ever. It's a new milestone and the 40th record close this year for the blue chip average. Investors snapped up stocks, encouraged by some better than expected news on the economy. The number of people filing for unemployment benefits fell last week. Producer inflation was kept in check in October, and U.S. manufacturing bounced back in November. And investors also seem to be getting more comfortable with so-called taper talk from the Federal Reserve. They recognize that stocks can continue to rally even as the central bank reduces its stimulus program. Here's a look at the closing numbers on Wall Street today. The Dow surged 109 points, ending at, here's the number, 16,010. The Nasdaq jumped nearly 48. The S&P added 14 points. Over in the bond market, yields on the 10-year Treasury briefly touched a one-month high before falling back and ending lower.
Well, joining us now to talk more about the markets and whether or not the great rotation out of bonds and into stocks is finally underway is John Manley. He's Chief Equity Strategist at Wells Fargo Funds Management. John, welcome back. Good to have you with us. So what are you seeing in your accounts, the accounts at Wells Fargo? Are people developing a better appetite for equities and leaving bonds?
I think they are. It's a slow process, and it's not really a one-step process. It's a two-step process. I think people are beginning to find equities less scary and more attractive, and they're beginning to wonder about their bond holdings. They know rates are down an awful lot, and we have to realize bonds go both ways.
John, I'm sure you, as many other strategists say, you still have to own some bonds. Are there some bonds that are still safe to own, or are you just better off putting your money into equities? Well,
safe is a relative term. I think you're better off putting your money into equities, but I do think the municipal bond market is reasonably well priced. I think some corporate spreads are reasonably well priced. I wouldn't go for the junkiest of junk, and I wouldn't go for treasuries, but there are things out there. But, keep in mind, Susie, I was 27 years old when the bond market rally started.
Well, I was a young cat, too, at that time, John, back in the 80s. Should I, if I'm inclined to invest in bonds, should I buy bond funds or should I buy the individual securities if really what I want is not to bet on the bond market, but to collect income?
I work for a fund company, so you can't say I'm unbiased, but I think funds are still the way to go. That's the way I go. I think it's important. You can't do the research. You can't get the economies to scale in terms of trading. You can't get the diversification. I think it's, and costs are, I think, quite reasonable, certainly versus historical norms. So that's the way I'd go, but you're asking someone who's a little bit prejudiced.
John, I want to explore a little bit more about the fear factor about why individual investors still have been so reluctant to put their money into stocks. And now today, we've got the Dow hitting 16,000. To some people, they cheer this. Others might say, this is even more reason to be scared of this stock market. Make a case about why it is time to rotate from bonds into stocks.
I think the perception of risk many times diminishes the actual risk itself. And I think that's what happened. There's no question the stock market got pummeled 5 years ago. And those of us who own stocks got pummeled along with it. But that's in the past. And unfortunately, these memories linger. People look back and they have a 180-degree deviation from where they should be looking. Multiples are still very reasonable as far as equities are concerned. Earnings are still rising, last time I looked. And when you look at the Federal Reserve, as you mentioned earlier, they may taper, but they'll only taper if it doesn't have a negative impact on the economy, and they'll remain accommodative for the foreseeable future. That's all good.
John, I was speaking to an executive of a major brokerage about a week ago, and he said it's very difficult for investors to find income today.
Yes.
And that they are having to take on more risk to find income given the fact that interest rates are so low. They're higher than they were, but they're still very low. Where would you tell people to go find income today?
I think high-quality equities is still the way to go. These companies have the ability not only to increase their payouts, but to grow their earnings and their cash flow underneath those payouts over a long period of time. You know, when people retire, they're looking at 15, 20, 25 years in the future. I don't know if you can find a bond that's going to give you the kind of duration you want. And remember, when you own a stock, you own a part of a living thing. I think it has the ability to grow, and I think for a long-term retirement, it's one of the few things that's left out there.
All right, John Manley, thanks. Great as always to see you.
Thank you.
Chief Equity Strategist at Wells Fargo Funds Management.
Well, how investors feel about buying stocks or bonds depends on what actions Janet Yellen takes as the new chief of the Federal Reserve. She's now a step closer to becoming the first woman to chair the Fed. By a vote of 14-8, the Senate Banking Committee approved the nomination of the central bank's current vice chairman to replace Ben Bernanke when his second term expires in January. The next step, the full Senate will vote on Yellen's nomination, but it's not yet clear when.
Uncle Sam is closer to getting out of the auto business. The Treasury just sold off 70 million shares of General Motors stock obtained in the 2009 bailout of the automaker. And it announced plans to sell its remaining stake of 31 million shares by the end of this year. Now, at current prices, such a sale would mean taxpayers would recoup roughly $39 billion of the $49 billion spent to rescue the automaker.
Before the opening bell this morning, disappointing earnings from discounter Target, and the stock fell sharply on the news. Profit fell 47%, with fewer shoppers hitting its stores and higher costs related to expansion into Canada. The company also lowered its full-year earnings forecast, expressing some concerns about revenue during the all-important holiday shopping season. Target shares fell 3.5%, making it one of the worst-performing stocks in the S&P today.
After the closing bell, earnings from the Gap, with profits rising nearly 10%. The stores are upgraded, new designer collaborations are selling, and Gap is making more money off of more contemporary fashions. The chain, which also owns Old Navy and Banana Republic, reported profits of 72 cents a share, excluding certain extraordinary items, and that was a penny better than expectations. Gap also reaffirmed its full-year guidance. It's going to boost an existing stock buyback plan by $1 billion.
The Gap is one of the many big retailers which has been overwhelming consumers with coupons, special sales, and other promotions this holiday season. That's making some analysts wonder if that strategy may backfire on those chains and whether bargain-hunting consumers will ever pay full price at those stores again. Courtney Reagan has more on how all those coupons and other deals are changing the state of retail.
Big sales are as much a tradition during the holiday season as Santa sliding down the chimney. It's what shoppers count on. But this year, the discounts are deeper, further reaching, and running longer than in years past. Promotions are great for shoppers, but retailers may be hooking consumers on a habit that's hard to break. Discounts are a necessary evil to win sales and traffic, but it also trains the shopper not to buy at full price and wait for the sale. Former JCPenney CEO Ron Johnson said coupons are like drugs to consumers. If that's the case, Gap, along with its Banana Republic and Old Navy brands, are enabling the addiction, flooding consumers' email inboxes with sale notifications every day. Analysts are pointing out the deep discounts at Gap brands, 30 to 40% off, in-store, online, or both. Macy's reported some of the strongest sales of the quarter so far, but at a cost. Increased promotions drove shopper traffic and sales, but merchandise margin took a hit.
We've been sort of shouting from rooftops the last 2 weeks that this year is going to be very different from a promotional standpoint. Walmart has stepped up the promotional environment more than they have in probably 20 years. Just operationally, I think everybody in retail is being forced in some way, shape, or form to react to that.
Lower sales prices compress the amount of profit per item that retailers pocket. Shareholders aren't going to be happy with that hit to the bottom line, but then again, some profit is better than no profit. Retail is as competitive as it's ever been, as consumers remain very cautious about discretionary spending. Uncertainty over healthcare costs add to the pressures holding back spending. And while falling gas prices usually give the lower and mid-tier shoppers more disposable income, it's not helping right now. So retailers are upping the ante on promotions to attract attention and traffic. But there's concern it's going to change consumer habits and what they expect. For Nightly Business Report, I'm Courtney Reagan.
Well, good news about U.S. homeowners who have been underwater, only owing more on their mortgages than their homes are worth. The real estate website Zillow.com says that in the just completed third quarter, the rate of underwater homeowners fell at the fastest pace ever, with 1.4 million Americans getting back above the so-called negative equity waterline. Easy for me to say.
But for the millions of struggling homeowners who remain underwater, fast rising home prices may not be rising fast enough. And with the housing market still in recovery, one company is hedging its bets that things could collapse again, and it's offering what's called underwater insurance. Diana Olick explains.
In Phoenix, Arizona, one of the hardest hit housing markets of the crash, home prices are up over 40% from the bottom at the end of 2011. That has cut in half the number of borrowers who owe more on their mortgages than their homes are worth. But nationwide, millions are still drowning in negative equity, and some are asking, could it all happen again? One company is saying yes and offering consumers insurance for that possibility.
Underwater mortgage protection is a first of its kind insurance product that we've created for homeowners who might want or need to move at a time when they're in a negative equity position.
Basically, it's gap insurance from Kansas-based AmTrust Financial. It covers the underwater amount should you need to sell your home. Consumers we asked were divided.
If you have the ability to leverage against risk in some way, it's worth considering.
I think it's not a good use of money.
To qualify, you must have at least 10% equity in your home now, and you cannot refinance during the coverage period. The average monthly premium is between $40 and $50, and this is not for high-end homes. Most markets will be capped at home values of $400,000.
We will be there to help consumers if they end up in a situation where life happens to them and they need to sell, and they might be in a down market.
But critics of the product say it's preying on consumer fear and the money might be better spent elsewhere.
For consumers that start out with 10% equity and are being asked to put up $400 to $500 a year in premiums, that same $400 to $500 a year can be on a monthly basis used to pay down the mortgage, which increases the equity and ends up having the same effect.
Millions of borrowers already pay either private or government mortgage insurance, which safeguards lenders. This product could protect both lenders and homeowners against foreclosures. AmTrust Financial says it will begin selling the insurance in 5 states next month and hopes to roll it out nationwide within a year. For Nightly Business Report, I'm Diana Olick in Washington.
For more on insurance for underwater homeowners, read Diana's piece on our website, NBR.com.
And still ahead, the new health law relies heavily on getting young people to sign up. But many first-time insurance buyers are finding, if they can log in, that the choices are huge and baffling.
A big victory for Apple in a patent infringement lawsuit against Samsung. A California jury ordered the South Korean electronics giant to pay Apple $290 million for copying patents from the iPhone and iPad without Apple's consent. As you recall, a previous jury awarded Apple over $1 billion in damages, but a new trial was ordered and a judge threw that award out, saying the jury miscalculated the amount that Samsung owed.
Well, the nation's second largest bank says it shouldn't have to pay anything for selling bad mortgages. Last month, Bank of America's countrywide financial unit was found liable for selling defective mortgages to government-controlled Fannie Mae and Freddie Mac. But the bank told a federal judge that under applicable law, it should have to pay about $1 million at most in the so-called hustle fraud case, not the $863 million in damages that the Justice Department seeks.
Mobile ads and a boost in listeners helped Pandora grow third-quarter revenue by 50%, and that's where we begin tonight's Market Focus. After the bell, the internet radio service reported a revenue beat, but the company swung to a loss as it spent more on content, sales, and marketing. That caused shares to fall initially in the after-hours session. Pandora closed the regular trading day at $29.68. It was up 4%. Fewer shipments and lower sales hurt Perry Ellis in the third quarter. The retail posted a $3 million loss, more than what analysts expected. The company blamed the numbers on weak customer spending, but despite the miss, its full-year forecast stayed intact. Shares rose slightly to $15.42. Micron Technology shares shot up today after investor David Einhorn announced that he's taken a stake in the company. The Greenlight Capital president said he sees growth potential in the name.
Earnings are going to be a lot better than people think. Next year, maybe $3.50 a share. The following year, maybe $4 a share. So the stock is about 19 or something like that today. And at that point, if you get even a reasonable multiple, you don't need a market multiple, you just need a non-ugly multiple that shows some stability and sustainability of that kind of improvement, and we can do pretty well.
The stock popped more than 6% on those comments to $19.99.
Well, the activist investor Carl Icahn also announced his position in Hologic. Icahn acquired 12.6% of the company, a women's healthcare products maker. In response, the company adopted a shareholder rights plan to protect itself from hostile takeovers. The news sent the stock nearly 2% higher to $22.70. Activists are pushing for change at Darden Restaurants. The parent of Red Lobster, Olive Garden, faces pressure from investors led by Barrington Capital to break up its diverse eateries. In their latest attempt, the shareholders hired an investment bank to review Darden's business model. The stock was up more than 1% today to $53.57. A buyback boost sent shares of Johnson Controls to an all-time high. The largest U.S. auto parts maker said it would raise its stock buyback program by more than $3.5 billion on a stronger outlook. Its quarterly dividend also got a bump up to 22 cents a share. The stock surged nearly 4.5% today to $50.35.
An update now on the Affordable Care Act in the most populous state, California. Covered California says that since the October 1st kickoff, nearly 80,000 Californians have enrolled in private health care plans through the state's online exchange. Data shows that more than a third of the enrollees in the state-run marketplace were aged 55 to 64, showing that so far more older adults have signed up for the new plans than younger ones in the aged 18 to 34 group.
Well, Susie, 7 weeks after the launch of the Affordable Care Act's healthcare.gov online marketplace, people are still having a hard time gaining access to the website. But once they log on and see all those insurance plan choices, they still have to choose which one suits them best. Bertha Coombs joins us now with more on the challenges facing some young people who are buying insurance for the first time and finding it very confusing.
Yeah, I mean, it's daunting for a lot of us who are used to buying insurance every year during open enrollment season. Choosing the right plan can be tricky, but for the millions of people buying insurance for the first time on these new health exchanges, there's a real learning curve here. And in some cases, because there are too many options and not enough tools to figure out how to pick a cost-effective plan.
30-year-old real estate agent Michael Chadwick is overdue for an MRI screening after having a benign tumor removed from his leg back in college.
The past couple of years, I've been in that great bracket of making too much money to qualify for aid, but not making enough with all my other bills to afford health insurance.
28-year-old graphic artist Katie Irwin has put off dental surgery and insurance for the same reason.
I just haven't been able to save up the money.
The New York City freelancers are exploring the new Affordable Care Act plans on their state's exchange. It's the first time they're buying insurance, and they're finding sorting through the differences between deductibles, out-of-pocket costs, and copays overwhelming.
So here's one of the dentals.
Katie found more than 70 options to choose among. Those with lower deductibles and dental coverage were pricey.
This is $374, and the tax subsidy that I get is $64.
She's leaning toward a catastrophic plan for her age group with a dental supplement for about $210 a month.
With catastrophic, I'm not spending a catastrophic amount of money.
Michael's also leaning for a lower premium option, but worries about high out-of-pocket costs.
So free physical, but if I get the flu and I want to go see a doctor, I still got to pay 50%.
Specialists at firms like online brokerage Gravy help people sort through those variables. Mike Fortner found Katie's catastrophic option is a good one, despite up to $6,300 in out-of-pocket costs.
When we dug deeper into this one, as long as she stays in the network, the first 3 visits to the doctor every year are free.
For Mike, who needs access to MRI screenings, Fortner thinks a mid-range plan will offer more.
He can have a little bit higher payment each month to the insurance company, but when he goes to use the insurance, the payments will be a little bit more affordable.
Columbia professor Eric Johnson says most state exchanges don't have the right comparison tools to sort out the trade-offs on plan costs, leaving most people to guess.
They're basically almost as accurate as if they were throwing darts.
That could be a costly mistake for people like Mike and Katie, and for the government and taxpayers who'll foot the bill for billions in planned subsidies.
We've calculated that if you actually do websites right and include the kinds of things that help people make better choices, every year you could save the government, that is us, $9.5 billion.
That's a very big chunk of change. Johnson says that California actually has one of the best calculators of all the new exchanges. Meantime, some news this afternoon from the Golden State. The Board of Covered California has decided against President Obama's insurance fix and will not let insurers extend canceled plans. They're joining Massachusetts, New York, and also Washington State. These are areas where the enrollment on the exchanges is going well, so they don't want to disrupt that.
Bertha Coombs, thank you very much. Appreciate it.
And coming up on the program, a look at Baltimore's leaky infrastructure and the money being washed away with it as our series Mission Critical, Fixing America's Cities continues.
Google is coming out with something new. The internet search giant will soon offer its own prepaid debit card, so you can pay for things at stores that also accept MasterCard, and you can even withdraw cash from ATMs. It's called the Wallet Card because it's tied to a user's Google Wallet account. That's a smartphone app and an online payment system that works like PayPal, kind of. Google says the card will be free with no monthly or annual fees.
Shares of Tesla, the luxury electric car maker, have taken a pounding lately after a series of battery fires sparked an investigation by federal transportation authorities. But owners of Tesla still love their cars. And a new survey from Consumer Reports shows Tesla Model S sedan received the highest customer satisfaction rating of any car the magazine has surveyed in years, with owners giving the car a score of 99 out of 100.
Wow. All this week, NBR has taken a closer look at the troubled finances of some big American cities. Today, we visit Baltimore, which has been plagued by leaks. Not leaks of information, but actual water leaks, as it faces a massive funding gap to maintain decades-old infrastructure projects. Scott Cohn has more.
All this water, and this isn't from a storm, it's from broken water mains. They call Baltimore Charm City, but the water system is cursed.
I know all the different things that are going on.
Stephanie Rawlings Blake is Baltimore's mayor.
We've had some mammoth breaks. You know, whole intersections have gone. We've had to reroute traffic.
On average, 3 water main breaks every day.
Every day in the city, somebody you know is dealing with a water main break.
In this 284-year-old city, the typical water main, like this clogged section of pipe, is more than 70 years old. Replacing them costs around $2 million a mile, and Baltimore has 4,000 miles. Then there's the other end of the system.
Wastewater is 99.9% water.
George Harwood is an engineer at Baltimore's Patapsco Wastewater Treatment Plant. He's been here 38 years. Environmental regulations keep piling up, he says, but the money to pay for them does not.
So you're kind of striking a balance,
yes.
Right? You want to make sure that the water is as pure as it can be.
And we want to be as economical as we can be, too, as we operate the plant.
Every improvement the feds and the state demand, like this billion-dollar facility under construction, is covered by ratepayers. This in a city with no shortage of other issues: blight, crime, the budget.
Everybody wants clean water. Everyone wants the environment to be pristine, but we're not growing money trees down in the basement of City Hall.
Baltimore has budgeted about $3 billion for capital improvements to its water system over the next several years, which seems like a lot, except that the need is closer to $6 billion. And nationwide, the estimates of water and sewer infrastructure needs are closer to $700 billion. And as cities try to make ends meet, they're also cutting some basic services like police. In the final part of our series, we travel to Trenton, New Jersey, where they've laid off a third of the police force with predictable results. Scott Cohn, Nightly Business Report, Baltimore.
And to read more about the cost of repairing Baltimore's infrastructure, head to our website, nbr.com.
Some good news for airline passengers who just love to talk, and bad news if you're sitting next to them. The Federal Communication Commission is proposing to let passengers use their cell phones on board planes as long as the planes are above 10,000 feet. This comes a few weeks after airline regulators loosened up restrictions on the use of tablets and e-readers during flights.
And finally tonight, talk about taking a wrong turn. This Boeing 747 jumbo jet used to haul giant plane parts and other cargo around the world landed at the wrong Wichita, Kansas airport last night, 8 miles from where it was supposed to be. The trouble is, the plane was so big and the airport runway so short that officials were worried the jet might not be able to leave. That runway was a half-mile shorter than the FAA standard for the plane. But there you see, the aircraft did take off safely this afternoon and hopped over to the right landing field. You can bet that the pilots of that Boeing-owned plane have a lot of explaining to do.
They sure do, Tyler. Well, that's it for us. That's it for us, Nightly Business Report. I'm Susie Garrett. Thanks so much for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great Thursday night, everybody. We'll see you back here tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant ratings service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. The Dow closed above the 16,000 level for the first time ever, a new milestone for the blue chip average and its 40th record close this year. Investors snapped up stocks, encouraged by some better than expected reports on jobless claims, tame inflation news, and a bounce back on U.S. manufacturing. Here's a look at the closing numbers on Wall Street. The Dow surged 109 points, ending at 16,010. The Nasdaq jumped nearly 48, and the S&P added 14 points. A California jury awarded Apple $290 million in damages in its patent infringement case against Samsung. And the Senate Banking Committee approved Janet Yellen's nomination to be the next chair of the Federal Reserve. The full Senate votes next. Be sure to tune in to Nightly Business Report right here on your public television station.